Hi, and thanks for tuning in to Talk ETFs, ETF.com's weekly video series. My name is Sumi Roy, and I'm Senior Analyst here at ETF.com. Today, I'm speaking with Ben Harburg, Portfolio Manager at CoreValues Alpha, which launched its first ETF a little over a month ago. Ben, welcome to the show.
Thanks for having me.
So Ben, I want to start off by talking about your newly launched ETF, the CoreValues Alpha Greater China Growth ETF, ticker symbol CGRO. You call it an America First China ETF. Can you explain what that means?
So it's one of the few, if only, ETFs that take into context a geopolitical variant as we evaluate the basket of stocks that go into the portfolio. And I think it's the only one that enables someone to access China Alpha, which we think is still a highly attractive market that's kind of at reached bottoms and is underappreciated for many of the wrong reasons today, but it enables you to invest in the China growth story without fear that you'll be called up in front of your investment committee or your pensioners or whoever else you represent, and instead looks at each one of our companies through a lens that is America first, as you said. So it looks at whether or not those stocks on their upstream or downstream supply chain or customer base contravene American national security interests, American values like censorship or some other human rights infractions, and even contravene America's technological and economic leadership. So it is very much looking through an America lens, but still enabling you to access China Alpha.
That's a really interesting twist on investing in China. Of course, though, over the past few years, there's been a lot more reluctance to invest in China, given the returns we've seen among various China ETFs. And we even have critics of investing in China who say that the relationship between America and China is just going to get worse and worse. The differences are irreconcilable. What do you say to those critics? How do you respond to that?
We have to separate those two baskets. One is financial performance and one is the geopolitics. On the financial performance side, we believe that we are starting this ETF at the opportune time. So it certainly has been a bumpy road over the last year or so, particularly as China extended its zero COVID in a draconian fashion that really undermined a lot of its own business interests, as well as, of course, the last couple years of regulatory interventions in a lot of the big tech names and other sectors across the market that gave pause to global investors and caused them to think that maybe China was not as predictable as they once thought, and certainly not as business friendly. The other side of that is the geopolitics. And so let's address the economic side first. Our belief is that we're getting in at the opportune time. So China is very much at its lows and bottomed. Most of the names in our portfolio have been kind of trading between a 1% to 5% up-down band for the last few months. We believe that a lot of the U.S.-China noise is and kind of negative noise is at its highest moments. And if you go to Washington, there's a lot of talk about everything from China's human rights infractions to just a sustained American effort to restrict access for Chinese companies to chips and other core inputs. So that negative rhetoric is at an all-time high. So our view is we're getting in at bottoms. We think that from a cyclicality perspective, China has now room to run. They've still not implemented a robust stimulus package. It's been a drip feed to date. Again, if you get on the ground in China today, you'll see that there's still a high degree of consumption. There are lines around the block for QSRs. Companies are reporting strong fundamental numbers, but the market isn't rewarding them for that. And so our belief is you're getting in at a good time, and particularly vis-a-vis the US, where I think there's a 70% or higher chance of a sustained and significant recession coming into next year. I think China still has very low interest rates, 3.5%. Has again a lot of levers to pull on stimulus. So our belief is that because of the decoupling of the two markets, you're going to see China emerging with better performance over the coming year than Western markets. Then on the geopolitics side, again, our view is a lot of it's overblown. There's a lot of very negative rhetoric, and actually those that are sitting in between the two countries are on a more constructive print today than they were. But that aside, we're not burying our heads in the sand about geopolitics. I think a lot of our competing China ETFs are simply hoping for better days ahead in the relationship. And as you said, I don't fundamentally believe that it will improve. And so what we enable you to do is access what we think is still a China that's growing at double the US on a GDP per basis at a large base, but do it in a way that helps you sleep at night knowing we're filtering out companies that might be contravening American values or national security interests. No one else is doing that. And that enables you to kind of have the best of both worlds.
Last question before I let you go, Ben. As you know, China has been doing a lot to support its stock market. There's been talk about the sovereign wealth fund in China buying China stocks and ETFs. President Xi Jinping recently made an unprecedented visit to the country's central bank. What do you think it's going to take to finally turn around the Chinese stock market and drive a sustainable rally that lasts for a long time?
So again, we need to first beat expectations, and we beat them for the Q3 numbers, and I think if Q4 does the same, some of that trust can be rebuilt. I've been outspoken to say that a lot of trust was broken, and it will take several sustained quarters of growth to rebuild that. Sustained stimulus. So again, today we just saw more significant stimulus packages being done. I think if we can also take some air out of the bubble and the negative noise around the real estate market, some bailouts or some stability provided to a few of the key names. We just saw again in the Q3 numbers that finally real estate prices are edging upward as they were on a downward trend. So I think we're headed in the right direction fundamentally. Now, what sets this ETF apart is its ability to go after those folks that still believe that China is a long-term opportunity. And I was talking to another fellow fund manager the other day who traded more in the hedge fund space, and they said, if everybody's running from China right now, it must be the kind of dead giveaway contrarian opportunity that we've all been looking for, and they are piling into their positions. A lot of people are quietly investing into China right now, but it's not popular to do so. And so again, by having our risk scorecard built by a highly experienced group of former White House national security staffers, military experts, commerce and treasury folks, it gives us the opportunity to position you so that you can weed out a lot of that negative noise, but still access the China growth story.
Fantastic. Well, Ben, a ton of great information. Thanks so much for taking the time to share your insights with us.
Thanks for having me.